Do only big players make money in the stock market? No, even common investors can build great wealth, if they follow the right strategy. But whenever you sit down to learn about investing, you often hear the same advice everywhere: invest in mutual funds, don't take risks. But is that really the only way? Peter Lynch's powerful book, Beating the Street, answers this very question. Welcome to Ease of Education. In this video, we bring you a detailed summary of this classic book, which will show you how even an average investor can achieve success in the market by making smart and profitable decisions. Peter Lynch, one of the most successful investors in the world, shares his personal investing strategies in this book. He says that if you have a little patience and a little creativity, you too can beat the big players. The biggest feature of this book? It makes difficult financial concepts easy and actionable. So if you too are looking for financial freedom in the stock market, then this book will work as a roadmap for you. Stay till the end, because we are going to tell you those powerful strategies, which can completely change your financial future. Before understanding the strategies, clear these things. At the beginning of the book, the author talks about some false beliefs that have taken root in our minds, and which need to be thrown out. First belief: you cannot become rich because you do not have tools like professionals. This is only half the truth. There is no rule that you have to invest money only in a few stocks or you have to be immersed in research day and night. This is not a 9-to-5 job where you have to follow the orders of a boss. You can do this at your leisure, comfortably, like a side quest that can lead you to the jackpot. Second belief: to identify good companies, it is necessary to immerse yourself in balance sheets. Now wait a minute, this is not the case at all. You do not need to carry a calculator around all the time. With a little observation, a little common sense, and fifth-grade math, you can often beat those professionals who are only engrossed in numbers. False belief 3: attaching to excitements. Despite the serious nature of investing, many Americans continue to buy stocks without proper knowledge, turning it into a reckless pastime rather than a disciplined pursuit. In most areas of life, when individuals realize they lack skill, whether in sports like baseball or hockey, they wisely step away and find a new hobby. Yet in the stock market, even repeated failure doesn't stop them. Instead of learning or walking away, they keep playing the market, chasing quick thrills and instant gratification without putting in the necessary effort to understand what they are doing. This careless approach to investing is incredibly dangerous. People who would spend weeks carefully planning a vacation, researching flights, hotels, and itineraries, think nothing of gambling thousands of dollars on companies they've barely heard of. They treat serious financial decisions with the same spontaneity as picking a vacation souvenir, undermining their financial future through ignorance and impatience. Investing without education or strategy isn't just risky, it's an ill-conceived habit that often leads to substantial losses and lasting regret. True success in the stock market requires discipline, patience, and knowledge, not the reckless pursuit of excitement. Without a solid foundation, playing the market becomes less of a game and more of a slow financial disaster waiting to happen. Investing is one of those fascinating things that blends art, science, and legwork, each playing a crucial role in how successful you become. Let's start with the science of investing. This is where the numbers come in, the spreadsheets, formulas, and financial theories. It's all about analyzing data, earnings reports, valuation ratios, and economic indicators. You use models and risk analysis to make calculated decisions. It's very logical and methodical, like solving a puzzle where each piece is backed by facts. But numbers alone won't get you far. That's where the art of investing enters the picture. This is more about instinct, creativity, and experience. It's about reading between the lines, sensing the potential of a company's leadership, feeling the energy of a new trend, or spotting opportunities others overlook. Great investors often have a gut feeling that can't be explained on a spreadsheet, but is shaped by years of observation and intuition. Then there's the legwork, the often underrated part of the process. This is the grind, doing the research, reading reports, listening to earnings calls, tracking industry news, even talking to people in the field. It's not glamorous, but it's absolutely essential. The best investors put in the hours, turning over every rock before making a move. In the end, investing isn't just a cold calculation or a lucky hunch, it's a mix of rational analysis, creative insight, and relentless effort. That's what makes it so challenging, and so rewarding. Let us learn the practical use of these three approaches, first understanding investing as an art. Just like the age of homemade pie is coming to an end, stock picking is a dying art for the average investor. Now mutual fund managers are doing what people used to do on their own. Wall Street professionals have been made celebrities by the media, which makes people think they can't compete with them. As a result, they put their money in mutual funds, even though most funds perform worse than the market. You can get good returns, and the author shares an anecdote in the book to prove it. When one day the author gets a report on how 7th graders started an investment club. They didn't look at heavy analysis or graphs, they just looked at the things around them. They invested in the products they liked, like Nike shoes or Disney movies. Very simple thinking, it makes more sense to invest in things we use ourselves. And now listen to the real miracle, these kids earned a return of 70% in just 2 years, while the overall market's return during the same period was just 26%. Not only this, their performance also beat 99% equity mutual funds. When this report reached Peter Lynch, he himself was shocked. Because it was clear, investing is not just an expert's game. With a little common sense, when you keep your eyes and mind open, and think simply, anyone can do wonders in investing, even schoolchildren. The secret of investing for children was very simple. Children were divided into teams of 4 students by their teachers, and each team was given a certain theoretical amount of money. Children had to write on a piece of paper which stock they were buying and at what price, but they could buy a stock only if they had a solid reason for buying it. For example, they bought 600 shares of Hasbro because its toys were selling well, 1,000 shares of Bank of New England because it had very less chances of going down, and 100 shares of Walmart because it showed a great growth rate. Their investments were not just on paper. The author himself came to know about Pentec International from the children's reports, whose stock had almost doubled in a short period of time. Let's understand, investing is a science, where you look at situations through the eyes of data, theories, and analysis. From a scientific point of view, you can closely understand the difference between the current situation and the changes that will come in the future. As soon as the market goes down, bad news starts pouring in from all sides. The media repeatedly tells how dangerous this crash is. And every new crash is said to be more terrifying than the previous one. The media around the world exaggerates it, sometimes citing wars, sometimes elections as the reason behind it. Ordinary investors get scared. They buy at high prices and are forced to sell at low prices. But in reality, this is the time when theory and data help you the most. This data shows you the way. Because if you look at the history of the last 70 years, the stocks that have given an average compound return of 11% have all gone through these ups and downs. And these returns are better than any other investment option. Moreover, in these 70 years, there have been 40 such sharp declines, where the market fell by at least 10% or more. Even on 13 of these occasions, the market fell by more than 33%. Yet each time the market recovered, and each time it grew faster than before. In fact, this is the time when you can buy real gemstones at cheap prices in the market. Peter Lynch explains that when an industry is going through a bad phase and everyone is avoiding it out of fear, then the real opportunities are hidden. He basically says, don't be afraid of bad news, but look into it. Because when everyone is selling out of fear, the shares of many companies are available at a price much lower than their real value. And that's where the profit starts. Lynch also shares some of his real-life experiences. Like in the 1990s when the real estate sector was in a downturn, everyone left that sector. But he saw some companies, like Pier 1 and Sunbelt Nursery, which were actually in good shape. Their fundamentals were strong, and when the market improved, those companies gave good returns. If the entire sector is down, some companies are still doing well, like managing inventory well, keeping debt low, and if insiders are buying their own shares, it could be a sign that they have confidence in their future. So, in short, Lynch is saying, don't follow the crowd. Instead of being afraid of bad news, do your research, look at the numbers, and maybe you'll find a great opportunity where everybody else sees risk. Now it's time for the legwork part, how to buy retail stocks. Peter Lynch always said, if you like the store, you'll like the stock. That's the essence of legwork. You go into a store, see if it's full of customers, good service, clean shelves, that's a great sign. You're just doing research as a buyer. When you find a store you like, you check its numbers, especially same-store sales. If they're growing, that's a good sign. You also want the P/E ratio to be reasonable, ideally equal to or less than the company's growth rate. And stay away from very fast growth. Even the best companies rarely grow faster than 25% per year for long periods of time. If they do, they usually burn out. Sometimes you find a company you like, but its stock seems too expensive. That's okay. Buy a little now, and when the market drops, buy more. It's a marathon, not a sprint. And if someone tells you, hey, this stock is already up 10 times, it's too late now, just pull out the Walmart chart. Great businesses can keep winning if they still have room to expand. Finally, real hard work means you're not buying a stock just because someone said so, you're seeing it in the store yourself, you're checking the company's debt, you're reading their reports, making sure they're opening new branches and growing the right way. If the story stays good, you stick with it. Easy, right? Stick with us until the end, because as a special bonus, we'll be sharing timeless investing principles directly from Peter Lynch himself. These insights have guided some of the greatest successes in stock market history, and they might just change the way you invest forever. You won't want to miss it. 1. Investing can be thrilling and rewarding, but risky if you don't put in the effort. 2. Your real advantage as an investor doesn't come from Wall Street analysts, it comes from within. You can outperform the pros by focusing on companies and industries you already know and understand. 3. Today's stock market is crowded with professional investors, but that's actually good news for individuals. By staying independent and not following the crowd, you have a better chance of beating the market. 4. Every stock represents a real company. Take the time to learn what the company actually does. 5. In the short term, a company's stock price and its business success don't always move together. But over the long haul, strong businesses inevitably lead to strong stock performance. Recognizing this gap, and having the patience to wait, is a major key to making money. 6. Always understand what you own and the reasons behind it. Blind optimism like, this one's a sure winner, doesn't count as a strategy. 7. Betting on long shots usually leads to disappointment. 8. Owning stocks is like raising a family, only take on what you can truly nurture. As a part-time investor, focusing on 8 to 12 companies is more than enough to stay sharp and make smart moves when opportunities arise. You don't need a massive portfolio, even 5 great companies can build your financial future if you stay committed. 9. If you don't see the right opportunities, have the courage to wait. Patience is power. If nothing stands out, keep your money safe in the bank and stay ready. The right opportunities always reveal themselves to those who are prepared. 10. Never invest blindly, understand the heartbeat of the business. The greatest losses come from ignoring the basics. Before you invest, dive into the company's finances. A strong balance sheet is your shield. Make sure a company is built to survive and thrive before you trust it with your hard-earned money. And that wraps up the key lessons from Beating the Street. Peter Lynch reminds us that with patience, research, and a little bit of courage, everyday investors can truly outperform the experts. It's all about staying curious, trusting what you know, and thinking long-term. If you found value in this summary and you're serious about growing your investing knowledge, make sure to hit that subscribe button. You don't want to miss the next breakdown of powerful investing books that could change the way you think about money forever. Also, drop a comment below, tell me which share market book you'd like me to summarize next. Your ideas will help shape this journey, and I'd love to hear what you're excited to learn about. Until next time, keep investing in your mind, and the money will follow.